All right, Chapter 25, Rewarding Business Performance. And so here we look at how we can take accounting information and use it to figure out the performance of certain areas of our corporation as well as the overall business entity, not necessarily a corporation, but any business entity, and also segments of the company as well, and reward those who should be rewarded and correct any action that needs to be corrected as well. And so really, there are three ways that your accounting system helps in goal achievement. The first thing it does is it helps to create and set goals. Usually this is done through the annual budget. And so once the budget is set for the year, what happens is the budget sits there as a measure, and so you can compare budget with actual results, and of course allowing managers to do this throughout the year shows them where they are versus where they should be, and allows them hopefully to take some corrective action. And then at the end of the year, this accounting system provides feedback to the various managers as to how they did. It also gives information to those above the managers on how the managers did, and then these upper managers can reward managers and those who work under the managers if they wish. So let's talk about some ways to measure performance. One of them would be looking at the companies or certain segments of the company's return on investment, which shows how they are producing operating income based upon the assets that are being allocated to that particular company or segment. And so return on investment simply is, your numerator is operating income and your denominator is average total assets. So you want this number to be higher rather than lower. The return on investment calculation can be further broken down into two additional segments called capital turnover and return on sales. And note, in both of these, capital turnover and return on sales, one common part of these is the sales. So capital turnover is sales divided by investment, and return on sales is earnings divided by sales. And of course, you've got in capital turnover, sales is a numerator. In return on sales, sales is a denominator, so they're going to basically factor each other out. But at least it helps to focus in on the various components of return on investment. And so here we have an example, and I think it's the same example they use in the book. And so we've got two segments of a company, fine china and cookware. And so here you've got year 1 and year 2. And so you've got sales, you've got your operating earnings for both. You also have your average capital invested in assets, so they give you that number. Normally, average capital invested in assets, though, is going to be your beginning year assets plus ending year assets divided by 2. But here they just give you the number. And so we're asked to calculate ROI for these two segments of a company. And so let's see what they're doing here. So they're doing cookware year 1 first. So operating income's $210,000, average total assets $1,400,000. So 15% is their ROI. And of course you get the same result by using these two components, your capital turnover and return on sales down there in the bottom. And so if a manager of this segment wanted to improve ROI, how can you do so? Well, you can do so by increasing sales. You could also decrease expenses, or you could lower your invested capital. You could also do any one of these three. In other words, it doesn't have to be just one of the three. It can be a combination of all three, 2 of the 3, 1 of the 3, whatever. But at least one of these things must happen to improve return on investment. Note here that ROI is fairly short-sighted. It doesn't really look out long term, and so a manager could manipulate the numbers to where it helps them and their segment short term, but it might hurt the business long term, the overall business long term, such as when they lower their invested capital, therefore inhibiting possible future long-term growth just to improve the ROI. So again, this is subject to manipulation, and because of the short-sightedness of it, as well as the short-sightedness of many managers who, you know, in a lot of companies, they get moved around. There's no incentive to look long-term, or very little incentive to look long-term if you're using ROI exclusively as your gauge for performance. And so here, let's see where they are in the book. So it says that the cookware manager was able to increase capital turnover despite flat sales revenue. Generating constant sales using a smaller amount of invested capital is one method that managers can use to improve capital turnover. So here, let's see what's going on. Here, what they've done is in year 2, reduced the average investment in assets from $1,400,000 in year 1 down to $1,300,000 in year 2. And despite the fact that operating earnings are actually down by $4,000 because of a greater reduction in average investment, $100,000, this manager's actually able to increase ROI from 15% in year 1 to 15.85% in year 2. And so, again, back to criticisms of ROI, I've kind of mentioned some of these. It's the first criticism is it's got a short horizon. It looks at short term, it does not look at long term. And again, because managers frequently move from one job to another and use short-term strategies rather than long-term planning, you're going to have these results where short-term results and decisions that come from those are going to outweigh any long-term decisions. If ROI is the only performance measure, it may present an incentive for a manager to reject a good project that would increase the ROI for the firm as a whole, because to the manager, it actually reduces his segment's ROI. And so there's an example of that. Down near the bottom of page 1085. And so here, if an opportunity arose in year 2 for the cookware division to undertake an investment of $500,000 with expected annual earnings of $55,000, which is an ROI of 11%, the division manager would likely not undertake the investment because the proposed investment would lower the cookware division's ROI to 13.95%, even though it would improve the overall company's average ROI to 9.05%. And so they give you the calculations there at the bottom of page 1085. A third criticism of ROI is the inherent difficulty in measuring both the average invested capital and the average operating earnings associated with that capital. Many times these assets that are part of invested capital are shared by various segments, so it's kind of hard to break those out when they're being shared. So ROI is a little bit of a difficult problem figuring out in that circumstance. Now, in response to the criticisms of ROI, experts have come up with different ways of trying to handle this problem. And so one of those is called residual income. And so here what you do is you take the it starts with the minimum acceptable return of a particular investment center. And so you take and multiply the capital that you plan to invest in a particular investment center times what management thinks is a minimum acceptable return, and that is called your investment charge. And to come up with residual income, you simply take expected operating earnings, subtract your investment charge, and see if you have positive residual income. And so they have an example on page 1087. And so here we're looking at this $500,000 project that's going to expected to bring a return of 55,000 operating earnings. So that's an 11% return. If the minimum return on those assets would be 10%, well, it's obvious that an ROI of 11% is greater than 10%, so you would accept that project. And so they go through on 1087 the calculations. Without the project, you've got 210,000 minus 10% times 1,400,000 equals 70,000. With the project, it's 210,000 plus the 55,000 additional operating income because of the project, undertaking the project, minus 10% times 1,400,000 plus 500,000, the total amount of capital that you'd have invested if you include this project, equals 75,000. So your residual income here is what? Well, it's $5,000. Notice that this particular calculation is not considered, is not used very much. So, at least residual income encourages managers to make a profitable investment that would otherwise be rejected by managers who use ROI. So from that standpoint, you might want to consider maybe a combination of using residual income as well as ROI. If you're not comfortable with just using ROI, which you really shouldn't. Another method that they talk about but don't really get into much detail is economic value added. And so supposedly this is a refinement of the residual income method. So feel free to look over the calculation. I don't ask any questions on that. Another method used by some companies is this balanced scorecard method. Notice that everything we've talked about, performance evaluation, deals with the numbers only, but believe me, there's a lot more to a company than just the quantitative matters. There's the qualitative matters as well. Customer service, customer satisfaction, employee satisfaction, employee turnover. It's more than just economic performance that can set a company apart from others. And so this balanced scorecard is a set of performance targets and results that show the organization's performance in meeting its responsibilities to various stakeholders. Notice it doesn't say shareholders, stakeholders, different organizations, different people have a stake in the company. Customers have a stake in the company, suppliers have a stake in the company, certainly employees have a stake in the company, certainly shareholders have a stake in the company. But when it says stakeholders, that does not mean shareholders. It's much more than that. Banks are stakeholders. Bondholders. And so this idea of total quality management includes a careful consideration of quality across the entire, what they call value chain. We looked at that some earlier. And so here, your value chain for this cookware division would include the suppliers, the cookware division. If they just make the products, then they're going to have a wholesaler involved. And down the value chain further is the retailer and the customers. And so certainly a financial perspective is a part of this balanced scorecard, but it's not the only part of the balanced scorecard. And so you have a business process perspective, you have a customer perspective, and you have a learning and growth perspective. And so if you look at Exhibit 25-9 on page 1089, that kind of gives you the components of each perspective, the different strategies that a company might have in place under each one of these perspectives, and then the ways to measure whether or not they're meeting these designated strategies. So we've kind of gone over the financial perspective, but looking at some of the others, some of these are, notice that financial perspective is pretty black and white, although, again, subject to manipulation, but at least the numbers are the numbers. And so some of these others are kind of squishy. They're subjective rather than objective like the financial perspective. And so improving customer relations. Wow. How do you measure that? Well, in this particular instance, what they've done is used customer retention, number of returns, and results of their customer satisfaction surveys. I assume that's what they're talking about, as a way to gauge this strategy of improving customer relations. Increase orders from profitable customers. The gauge they use is market share and customer profitability. So they're looking at their customers, I guess the wholesalers and retailers, and determining how maybe they've contributed to their profitability. I guess that's what that means. Business process perspective. So here you're looking at improving supplier relations, and another squishy strategy. They measure that by determining the number of quality certified suppliers that they have, the number of vendors, things like that. So anyway, take a look at that. And then learning and growth perspective, they're talking about the employees of that particular company, looking at turnover, looking at employee satisfaction, things like that. The difficulties with the balanced scorecard is the organizations have a difficult time assessing the importance or weights to attach to the various perspectives that are part of the scorecard. Measuring, quantifying, and evaluating some of the qualitative components, those last three, are part of the balanced scorecard, present significant technical hurdles. And difficulty arises from a lack of clarity and sense of direction because of the large number of performance measures. And then the time and expense required to maintain and operate a fully designed system can be significant. One thing they can do is cut down on the number of strategies they have, and the objectives or the measuring sticks they use for those strategies. If you're a manager, if you're in top management, how do you motivate your managers? Well, certainly you can do that a couple of different ways, and so here we have an example of someone who prefers a fixed salary. You know, there's something to be said about certainty, but does a fixed salary necessarily motivate a manager to continue to improve the segment of the company they're responsible for? And so you might have a fixed salary. Certainly that's always a component of any compensation package, but the real motivating factor may be in these other bonus arrangements that you have with your lower level managers. And so they might they might want something like a profit sharing plan or a stock option plan available to them. So here are some choices that have to be considered when designing a management compensation package. Should we reward current performance or future performance? Should teams of employees share bonuses equally, or should they be in competition? Should bonuses be fixed, or should they vary with a performance measure? Should our rewards be based on accounting numbers or stock price performance? And should bonuses be based on local or company-wide performance?